When you don't know from which side the punch is coming, you protect from all sides. That's a straddle. Let's decode the two opposite ways to trade the market. One with absolute uncertainty, while the other one during complete silence. I am Pranav VK, an NISM Certified Trader and Trainer, and you're watching Stockshaala by Kotak Securities. In this video, we're going to discuss about long straddle as well as short straddle. A straddle involves both call and put for the same strike and same expiry. So what's the logic? One of the strategies is going to make money when the market moves historically on either side, while the other one is going to make money if the market sleeps and does not move at all. So basically, there are two types. The first one is a long straddle, where you buy put option as well as a call option for the same strike and the same price. Here, you don't know which direction the market is going to move, but you know that there's going to be movement. And that is when you're going to use a long straddle. The second one is a short straddle, where you're going to sell a call option as well as a put option for the same strike and same expiry. In this case, you know that the market is not going to move at all and it's going to stay within a specific range. So let's understand long straddle with an example and see how we can make a profit and how we can also look at the risk to rewards of this specific strategy. So here I've taken an example of Nifty at 20,000. And let's put a long straddle and see what is going to be our risk to reward as well as break-even points. So buying a 20,000 call option and buying a 20,000 put option is going to create a long straddle for me. So in this case, when I was buying the call option, it was rupees 80 premium that I had to pay. And when I was buying the put option, it was rupees 90. So the total cost for entering into this strategy is rupees 170. And the break-even points is very simple to calculate. It is nothing but 20,000 plus or minus rupees 170. So on either side, the break-even point is 19,830 or 20,170. So for the long straddle to make profits, it has to go beyond these break-even points. Only then it's going to make a profit. Otherwise, it's going to be a total loss of rupees 170. The profit in a long straddle is going to be unlimited on either sides beyond the break-even points. So now I'll show you the payoff diagram of a long straddle so that you can visualize it better. Here you can see that the y-axis has the profit and loss. This is the break-even point, and the x-axis has the possible strikes on the day of expiry. The orange lines represents the loss area and the blue lines represents the profits. So as you can see, beyond the break-even points, this specific strategy will start making profits. But if the market stays within this range, then the total loss of 170 rupees is going to be there. But since as and when it approaches the break-even points, the loss starts reducing. But only at the apex region, the total loss is going to be the maximum loss, that is rupees 170. Now let's discuss a short straddle, which is also called as the boring market strategy. A short straddle is an exact opposite of a long straddle. So I've taken an example here of Nifty being at 21,000. So in this case, we are going to sell a call option as well as a put option of the same strike, same expiry. So of course, the premiums are going to be a little different. So for the call option, it is 110 rupees and for put option, it is 80 rupees. So the total credit I'm getting for this strategy is rupees 190. And the break-even points is same 21,000 plus or minus 190, which is 20,810 and 21,190, which means if the market stays between these two numbers, then you're going to be in a profit. But otherwise, you're going to start making a loss. Now I'll show you the payoff diagram of a short straddle so that you can have better visual clarity. So looking here, on the y-axis we have profit and loss, and on the x-axis we have the possible strikes at the end of expiry. Now we can see that the break-even points are here, two break-even points which are marked as PE and DE. So if the market stays between this range, then you're going to get profits. And maximum profit is only possible at this apex point only. And as and when it approaches the break-even points, the profit also starts reducing. And beyond the break-even points, the losses become unlimited on either sides. Since short straddles have unlimited loss potential, it is best used by advanced traders and with absolute good risk management. Now that we have learned both long straddle as well as short straddle, let's do a quick comparison so that it stays in your mind. So in terms of market view, when you expect a big move, that is when you go for a long straddle. Whereas if you expect no move at all, that is when you go for a short straddle. In terms of risk, in a long straddle, it is only to the extent of the premium paid, so it has limited risk potential. Whereas for a short straddle, the risk is unlimited. In terms of rewards, a long straddle has unlimited profit potential, whereas a short straddle has only to the extent of the premium received. So you might be wondering, when should you use long straddle and short straddle? It's very simple. If you're trading just near events and you expect some kind of breakout on either direction, that's when you go for a long straddle. But you expect a range-bound expiry, that's when you can go for a short straddle. Implied volatility, that is IV, plays an important role when you're entering into either of these straddles. If the IV is low, that is when you can go for a long straddle. But when you're entering a short straddle, your IV must be pretty high. And remember that when you're going for a short straddle, Theta Decay is your friend, but when you're doing a long straddle, Theta Decay is your enemy. Here is a pro tip. Use the straddle pricing to estimate the average move. For example, if the call option and put option put together comes up to around 200 rupees premium, then you can expect the market to move by 200 rupees either side. So let's summarize what we have learned so far. We understood that straddle is nothing but a combination of buying or selling call option and put option with the same strike and the same expiry. While long straddle can help you bet on big events where you expect a movement on either direction, short straddle is going to help you make money even when the market is range bound. Make sure to choose them wisely because one makes money when there is chaotic movement while the other one makes money when the markets are calm. In the upcoming video, we will explore the distant cousin of straddle, that is Strangles. Same logic but wider range and discounted premiums. You are watching Stockshaala by Kotak Securities. I am Pranav VK and I am going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.